And good evening, everyone. Welcome to another edition of Saturday Night Live and Rambling. I'm Clay, joined by the E Train, the renowned, lovely, and gracious E Train, who will be the main irritator for the night,
It's my job.
in in charge of the rambling.
Yes.
So
Want to say hey to everybody on X, YouTube, and Rumble. Thank you for being here.
we do appreciate y'all joining us. Hope you're having a good Saturday night. Hope all your favorite teams have won. Um, unless it's
Mine didn't
Bama.
last night. The Yankees lost the
Oh, the
Dodgers,
Yankees.
game one.
Yeah.
Not real happy about that.
Are they playing in LA or New York? Do you know?
LA last night and tonight, and then New York the next two nights.
Next two or three?
I think it's two.
Okay.
I'm sure chat can help me out with that anywhere.
Who's
Rumble.
who's favored? Aren't the Yankees favored?
They better be. They are in my book.
All
I've been a Yankees fan
right.
since I was knee high to a grasshopper.
Yeah. I kind of gave up on professional baseball back in the 90s, professional sports in general. I remember a pitcher. I don't remember his name. I remember his face, but the player, this was the first baseball strike. And he was being interviewed like, "Why are you guys striking? You make $1 million a year." And the guy looked at the reporter, and just as serious as he could be, he said, "You don't understand how difficult it is to provide for your family off of $1 million a year." And this was in 95.
Hmm.
Anyway, that did it for me. I was done with professional sports at that time. Really have not tracked them closely since. If it's
Okay.
any consolation for those who aren't exactly Yankees fan, I grew up a Red Sox fan, watching Carlton Fisk, Louis Tiant, all of those guys, and the Oakland A's with Jackson and Campanella and just the whole horde. Won 3 World Series, but I love Carlton Fisk. Great, great player.
One of my dads was a Red Sox fan. Another one was a Braves fan, and the other one was a Baltimore Orioles fan.
You don't see many of those anymore.
Why? Why I'm a Yankees fan, I have no idea. I was there when Cal Ripken had his, oh God, what was it? Some ridiculous amount of games.
Consecutive game, like
Yeah.
3,000 something
hmm
games. Yeah,
Yeah. I was in DC then and went to that game.
yeah, he's a good guy. I always like
Mhm.
Cal. I can't say I've been completely oblivious to baseball, just have not followed it closely.
Fair enough.
Hope everyone is having a good Saturday night, having a good weekend so far. It's been pretty down here. Kind of the best time of the year in some ways. All the Turons are gone, and it's peace is being restored.
The Torons.
Turons, kind of a local nickname. We you
hmm
know we kind of have a love hate relationship with the tourist. Know that there's the businesses here depend on their business. But if you are a native, if you live here, then it gets real crowded. It's hard to go anywhere. Traffic's all backed up. You go to the beach, it's crowded. So it is, like I say, kind of a love hate relationship. But if you're a tourist, we appreciate you coming. Just go ahead and leave.
Hi, Jane.
Hey, Jane, how are you doing? Good to see you. Hope you are doing well. Jane is a longtime and much loved member of the family. So always good to see her.
She fills in for either Clay or I on occasion when it's
Yes, she
necessary,
does.
when we can't make it.
And she is is it herbologist? Our herb expert?
Herbalist. Herbalist.
Herbalist. Okay. And we've had a couple shows on herbs and trying to, provide for yourself. We've got the Moffat on Money store that actually has a little section dedicated to um,
Solar
items.
cooking. Yeah.
Yeah, solar cooking. I couldn't think of the name of it. Thank you.
And it's in the descriptions on the channels, either on
On the
X,
YouTube.
Rumble, or YouTube.
It's on all
They're
three.
all on
Okay.
there. Yeah.
And also, if there's something you buy routinely from Amazon, let us know and we'll add it to the page. It doesn't cost you anymore. It's just a way of supporting the channel. So wanted to throw that out. Also want to ask you, if you will, this is kind of a good chance. Throw this out real quickly. If you will, just do the YouTubey things
Or the rumbly things.
or the rumbly things or the Twittery things. Just hit the like, subscribe button. It does help us out, helps us broadcast our channel. And we appreciate it. Tonight, we're going to be delving into investment strategies that I guess are as dependable as gravity, as almost inviolate laws of investing. And they're not only dependable, but in a lot of ways they're ruthless, as I would describe them. And so we'll kind of look at that as we go through. We want to start by admitting that the market is volatile. And when I say volatility, I'm talking about its ability to move or rise or fall any given day by any amount. If it's a small amount, it's not very volatile. If it's a larger amount, it's more volatile. And second main point that you need to keep in mind throughout this is that risk and return are always commensurate. If you want a higher return on your investment, you have to take a higher risk or be willing to accept higher risk. So keep those two ideas in the mind. I'll throw out, sometimes I'll talk about the market being volatile or volatility. That's what I'm talking about. And whenever I talk about risk or return, they are always intertwined. So keep that in mind. Now, we're also going to be talking about tonight two different paths, so to speak, to investing. And I'll be using it as examples, two of the best performing investors of all time. Warren Buffett, which a lot of people know, and Stanley Druckenmiller, which a lot of people aren't all that familiar with. And a lot of times I just short it and call him Druck. But they share timeless lessons. Both of them are not very secretive about what they're doing or how they do it. And they share what I consider to be timely lessons in vastly different styles. So we're going to, take a look at some of the basic rules to see how they kind of implement those. And, this show is not about just a blind admiration. It's about a practical application. We want to look at rules for investment success, kind of like when to play offense, but there's also a time to play defense. A lot of people ignore that side of the game. And, we'll share some information, stories, experiences from Warren Buffett and from Stanley Druckenmiller to kind of help us, inform us, put some perspective on the rules as we go through. Now, we're going to start out with what I would call 7 basic rules for investing. Then we'll look at the practical implementation of these rules with
And if
two
you
of the
guys
most
have
successful
any
managers.
if you guys have any questions, please throw them up, Rumble. I'm watching you. And I've got X and YouTube up here. So yes, I do move my head around a lot and eyes around a lot. So just letting you know, I'm here for you.
Yeah, we do. We do want your questions. We do want your comments. I don't mind gabbing. I actually get paid to do it for a living, so to speak. But we're really here to try to help you. And a good part of that is your participation with questions, comments, whatever. So
You won't get a trophy. You won't get a trophy for participation, but
you may get
we
you
would
may get a
like
reward in heaven.
participation. True. Or in your investments.
So here are the basic rules for investing for beginners or for experienced investors. And the understanding has to be you never get away from the basics. First one, investing for the long term. Patience is rewarded in the market. Now, there are short-term market movements which are obviously unpredictable. Nobody can predict what the market's going to do. And in my classes, I talk about how stock prices move. And they'll be up, they'll be down, they'll be up, down, down, up, 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 down, down. There is no way to predict the next movement in the stock price. Not consistently, not reliably. But the market has an upward bias. Over time, it consistently grows, increases. Now, the path it takes to get from the price today to a price a year, 5 years, 10 years from now is wholly unknown. It'll vibrate. But you can be relatively confident based on the past 100 years that it has a pretty strong upward bias. So we can't predict short-term movements, but we can have some confidence long-term. That's why we say patience investing is rewarded. Now think about Warren Buffett's philosophy. He has the saying, our favorite holding period is forever. And Buffett is a notorious buy and hold investor, and he has been by far one of the most successful investors in history. He understands the magic. The magic is the long-term compounding, the compounding of, I want to say interest, but it's the compounding growth of the stock. And that's where the magic happens. That's where a small little return becomes bigger and bigger and bigger and then grows enormously. If you remember the little old red-headed lady, a story I've told a couple times, you remember what the difference in a 3% return did to her over 30 years. A 3% difference took the value of her portfolio, or would have taken the value of her portfolio from 400 and something thousand to over 1.6 million, 1.3 million. Every little percent matters. That's where the magic is. Second basic rule is if you want to manage risk, if you have uncertainty or feel concerned about the risk in the markets, you probably want to diversify. If you want to increase risk, don't diversify. A lot of people teach diversification as if it was the holy grail of finance. I don't. There are times when I have uncertainty, I'll diversify. There are times when I have very little uncertainty, the market on a particular asset or the risk in the market. I don't diversify. I'll go 100%. And diversification, what do I mean? Diversification is the concept of investing in wholly different types of assets. Now, if I buy Apple and I buy Samsung, think about it. They both kind of sell the same products, phones. They both produce their phones in the same region, use the same labor. They both have the same raw material inputs. So if there's a problem with labor, they're both hurting. If there's a strike, if there's a problem with a particular raw material or a chip, Ellen's up to her usual there.
I'm just trying to get everything kind of on the same plane.
It's all right.
Sorry.
That's all right. So if you buy those two companies, you're really not diversified because they have the same risk. But if you buy Apple and Amazon or Caterpillar, they don't have the same labor structure. They don't have the same regional production facilities. They don't have the same raw materials inputs. They aren't affected by the same economic actions. If there was a tariff put on Chinese products, phones would increase in cost. Caterpillar's Tractors would not be impacted. So that's diversification. Or you buy stocks, you buy bonds, you buy gold, you buy real estate. Those are all different types of assets with all different risk profiles. That's diversification. Just buying tech stocks is not diversification. So the idea is by spreading your investments across different types of assets, you're better shielded against significant losses.
Moffat, you got to do me a favor.
Yes, ma'am.
You got to turn the brightness down on your light, please.
Let me see if I
You're
can do
shining like
that.
the top of the Chrysler building, at least on a couple of my screens.
Yeah.
There should be a button on the back of it. That's better. Thank you. Oh, nope.
Okay.
You're back to being bright.
Well, that's about as dim as it's going. That's off.
That's better,
All right.
in my opinion.
No problem. As long as E-Train is happy, everybody's happy. So we'll go with that.
Okay.
The idea about diversification, if you think there's a lot of risk in a particular, market, diversify. On the flip side, if you think there's a great opportunity and you're comfortable with the risk, don't diversify. As Druck once said, bears make money, bulls make money, and pigs get slaughtered. He was raised on that idea. That's a common phrase. But he goes on. He says, "I'm here to tell you, I was a pig, and I strongly believe the only way to make long-term returns in our business that are superior is by being a pig. I think diversification and all the stuff they are teaching at business school today is probably the most misguided concept anywhere." So that's a hell of a statement. And it just kind of reinforces if you have, good knowledge, good understanding, and you think there's a tremendous opportunity, go into it strongly. If you're uncertain and don't have any great conviction, then you probably want to diversify. Now, there was, Druckenmiller gave a speech in 2015. I actually found a copy of the speech online. And he had this little section, and I'm just going to read it to you because I thought it was highly instructive. He says, if you look at the great investors that are as different as Warren Buffett, Carl Icahn, Ken Lagune, they tend to be very, very concentrated bets. They see something, they bet it, and they bet the ranch on it. And that's kind of the way my philosophy has evolved, which was if you see only maybe 1 or 2 times a year, you see something that really, really excites you. And if you look at what excites you and then look down the road, your record on those particular transactions is far superior to everything else. But the mistake I'd say 98% of money managers and individuals make is they feel like they've got to be playing in a bunch of stuff. And if you really see it, put all your eggs in that one basket and then watch that basket very carefully. And I think that's the idea. If you see something that you think is a really good opportunity and you think things are moving that way, a couple of years ago, you might have thought AI had tremendous potential. You saw that company. You see all the companies start increasing their orders of AI chips. You see, all the the major tech players putting tons of money into developing AI. If they're doing that, it's something that probably has a good future. If companies are doing that, if you see that, that might be something you want to place a strong bet on. It doesn't mean owning a bit of everything is always advantageous. It does mean balancing your assets based on risk and the risk out there. Third main rule: invest in good times, invest even more in bad times. This is simple and it's brilliant. You always want to invest, even if it's just $25 or $50 a month. Begin that discipline if at all possible, and increase it as your pay increases. Then, when the markets collapse, invest even more if possible. You will win. Number 4 kind of ties into number 2 as well, but thought I would just go ahead and list it specifically. Understand what you're investing in. Never, never invest in something you don't understand. Knowing the ins and outs of an asset or a company can help you make informed decisions and avoid unnecessary risk. As Peter Lynch, another hugely successful money manager, ran the Magellan Fund for 15, 20 years. He says, invest in what you know. So make sure you have a good grasp of the business, how it makes money, and of the industry dynamics. And if you think it's a great opportunity, then do it.
Does that also include cryptocurrency?
That includes any investment, any and every investment. Number 5, this is something a lot of people have difficulty with, but it's one of the most important. Stay calm and avoid emotional decisions. Market downturns, if you track your portfolio every day and you're watching it and you start seeing the market fall, a lot of people kind of get anxious or in a panic. Sometimes they'll see sharp upswings and they think, "Oh, I need to jump on this." What's the theater? Not GMC.
GM?
Oh,
No.
no, GameStop.
MGM? Oh, yeah, GameStop. What theater's GameStop?
Yeah, sorry.
I'm confused. Okay.
Yeah, the GameStop. A bunch of people piled onto it when it was soaring, and they bought it at 200, 250, 300, 350, 400. Well, the stock's now, I don't know, $10, $8, $15, somewhere around there. Never, never buy when you feel pressured. Never, never, buy emotionally. AMC was the other one I was trying to think of. Staying calm and sticking to your plan prevents costly and emotional mistakes. Fear or panic or enthusiasm rarely, if ever, leads to a good decision. Now, remember, the market is most volatile in the short term. So sticking to your strategy in the short-term ups and downs can yield better returns. The math actually works out in your favor. 6th rule is reinvest dividends and capital gains. A lot of people will take their dividends as cash and spend it, or their capital gains. Like if they have a mutual fund or ETF, it may distribute those to them as cash, kind of like a dividend. Well, they spend that. No, just no. You leave it in and allow it to reinvest. Again, going back to the little old redheaded lady, that 2 or 3% a year makes a big difference over 10, 20, 30 years. Makes a huge difference. And the last one, or 7, is keep costs low. A lot of people will invest in mutual funds, but they may invest in mutual funds with a high expense ratio or commissions. Well, those expense ratios, those commissions erode, they lower your returns. They cut your returns. So opt for lower cost investment options like index funds or ETFs when possible. Jack Bogle, the founder and CEO of Vanguard, said, investing, you get what you don't pay for. And yeah, that's right. If you don't pay fees, if you don't pay expenses, if you don't pay commissions, more of your money goes to work for you. So you're adding, a percent per year to your returns. It's far better in your pocket than it is in somebody else.
By the way, I'd hate to interrupt.
No, you're fine.
A friend of mine, I think you know him, Stuart. They had their baby last night. Yay. I just got a picture. Pretty excited. I've known him since he was in college. Wonderful dude. He just sent me a message. Sorry.
Okay.
Babies. They're cute.
Did I mention Ellen's in charge of the rambling?
That would be me.
That would be Ellen. I kid you not. But we love her. Finally, contrarian. And we'll see that at work as we go through this. Contrarian is not following the masses. I already talked about don't be emotional. Don't feel like you've got to make an investment because everybody else has and it's moving. So we'll look at that as we go through. So let's take a look at Buffett's rule number one. Rule number one, never lose money. Buffett's number one rule. Rule number two, never forget rule number one. That's, again, simple, but extremely elegant. Brilliant in its simplicity. Now, this isn't about zero risk investing, but it's really about trying to mitigate losses. And I've got it's a relatively simple little graph of the S&P 500 taken during the 2008 subprime crisis. You know what? Thought I had this up, but I don't. I don't know if it got taken down or what. See if that's better. Sorry about that. So the yellow line is the value of the S&P 500 crashing during the subprime crisis. And ultimately it went from about 1,500 down to near 820, 830. I forget exactly where it bottomed. But it was a 50% drop. So you see that, you see everybody panicking, you see people, frustrated, getting mad, giving up hope on the universe. Well, what's Warren Buffett doing? Well, his financial crisis strategy was when most everybody was selling, he started buying. And these little red X's you see are where he started buying. 2008, after the Lehman crisis, and then the month after that, he started making large purchases in distressed firms, but firms that had value, firms that were going to survive, but were just victims of this total market crash. So while everyone was screaming into their morning coffee, Buffett was, calmly pouring himself another cup. You don't want to make emotional decisions. You don't want to panic. You got to realize that this is an opportunity. When everybody else is bailing and selling, when it looks like the worst has passed, that's a great buying opportunity. Flip side is if you see risk greatly increasing, you want to do the opposite. Now, Druck, who tolerates a little risk to earn big returns, once said, and I believe this firmly, the best way to make money is to minimize drawdowns. So preservation of your capital is paramount. Simple example. If you have $1 invested and the market drops 50%, you have 50 cents. That's what you have, whether you have sold that investment or not. You have 50 cents. The market dropped 50%, but you need 100% return to get back where you were, to get back to your dollar. That mathematically demonstrates why avoiding huge drawdowns or significant drops in the market can be extremely beneficial to you. You look at the market crash of 1987. Computers crashed and the market fell 32%. Yeah, 32%. It took almost 9 or 10 months for it to get back. But if you had invested in the market after that crash, you would have made 32% in 9 months. So the application, don't lose your cool. Don't lose your cash. Avoid risk to the system when you see them. Now, 5 or maybe 10% corrections, drops in the market, you can't really ever predict those. They're going to happen. You can't time those. But when the economy is slowing down, looking like it's going into a recession, if a war is starting, if you see private business and ownership going to be increasingly restricted or limited, corporations are getting less optimistic. Those are system-wide issues. And that might be a time when you want to start becoming more defensive in your investment position. Now, the next rule is, stay in your lane. Invest in what you understand. Buffett is notorious for sticking to his, what he calls, circle of competence. For decades, he avoided tech because he didn't understand it. But he still built Berkshire Hathaway into a huge billion-dollar company based on companies like Coca-Cola, American Express, Dairy Queen. There's nothing sexy or glamorous about any of those, but they've got good, solid products. They've got, regular customers. They aren't necessarily susceptible to, big economic swings. He started buying Coca-Cola in 1988, and it was no fluke. He knew Americans. He knew their brand loyalty. He knew a thing or two about sugar. Fast forward today, he invested $1.3 billion. It's now worth about $25 billion. And you can see the growth through the years of his investment. Buffett will say, most people call it soda, but I call it my retirement plan. Now, Druck is a little bit more flexible, but he also admits his worst performing investments are when he strayed from his core knowledge. For example, he's told the story of in the late 90s, he broke his rule. He succumbed to peer pressure during the tech bubble. He bought .com stocks and he quickly regretted it. The key point is know your lane, know your domain, whether it's old school beverage companies or new tech, understand it inside out before you buy in. If you don't know enough about specific companies, but you believe in the future of an industry, then again, buy mutual funds or ETF, obviously with low fees, but that would make the most sense. Tech, does it have a good future? Most likely. People are going to be increasingly dependent on it. Healthcare, whole of society, demographics are aging. Demand for healthcare is only going to grow. Those, gold, energy. Do we have a rapidly growing need for cheap and reliable energy? You don't have to be an expert in the field to know some of those things or to have a good impression for some of those things. If you're not intimately familiar with the companies or don't know which one to pick, then there are a number of mutual funds or ETFs that would make good choices, and they're relatively easy to find. Now, market timing versus time in the market. Now, this is a picture I stole. Um, and I had the site attributed. I had to search for it, but don't have it. So I will try to find it and give them credit here shortly. But I thought this was a fascinating, long-term graph of the market. The only hesitation is it's in euros, which is kind of weird, but nonetheless, this still demonstrates the same principle. If you look at the trend in the market, you can tell there's some dips and some bumps. The growth is not steady, but there is a strong upward trend. And there are a few times where you see the serious events like 9/11. When 9/11 happened, you knew there was going to be a war. So, one, you knew defense stocks were going to do well, and probably most other stocks not so well. Well, what do you know? That kind of ended up being the case. The subprime crisis. Once you started seeing um, companies like Bear Stearns, Deutsche, BNP, Countrywide, Northern Rock all start failing, you could tell relatively easily that the financial sector was having tremendous issues. If the financial sector collapses, obviously the market's going to collapse, and it did. So there are occasions when you can tell risk in the whole system is increasing. That's the time when you want to try to start being more conservative. The other time, you just live with the little vibrations, the little corrections. And never rush for the latest craze. Be a little bit like Buffett. Be patient. He looks at each new bubble in the market as like a passing ad in his morning newspaper. It's just not going to impact him. There's always opportunity that will arise, but not all the time is the right time. You have a steady, regular investment, but if you see, risk growing in a sector in the market as a whole, get a little bit more conservative. Now, Druckenmiller has we've kind of described a little bit different approach. He has an all or nothing. Druckenmiller will make big bets. And probably the one he's best known for is he famously bet against the British pound in 1992. He was managing some of one of George Soros's funds. And this particular trade made $1 billion in one day. You might call it a pretty effective trade. Now, Druckenmiller placed a huge bet against the pound, and it wasn't luck. He anticipated that the Bank of England couldn't maintain the current peg against the Deutschmark. And his patience paid off in one of the greatest trades of the 20th century. You can see the black dot shortly before 93 when he made the trade. And as this line goes down, he makes more and more money. And then you have the sharp drop. So it wasn't necessarily an instant success, but it was pretty damn successful. They put on probably about an 11 or $12 billion position. Ended up making 25, 28 billion. That's not bad over a year. And what did he know? Druck was obviously studying all sorts of economic and interest rate data, but he saw that the the Bank of England was getting near a recession. And so they were starting to lower rates. Lower rates generally means the value of your currency will fall. Meanwhile, Germany, the Deutschmark, had just a year or two earlier broken away from the collapse of the Iron Curtain. And so they were reuniting with Western Germany, and there were, all sorts of problems with that, and inflation was starting to take off. Well, the Germans running the German bank had a very clear memory of the inflation in the pre-Hitler days, and they were adamantly determined to kill inflation. So they do the same thing that the Fed did in this country, hike rates. So you had Bank of England cutting rates, Germany hiking rates. Well, Druck knew that there was no way to keep the exchange rate the same and that the exchange rate would not work out in the British pound's favor. That's why they shorted the pound, because they expected the value of the pound to drop against the Deutschmark. Nailed it. Absolutely nailed it. So again, that knowledge he was able to turn into profit, very, very large profit. For most people, if you're not that well informed, you don't have time to track things in the market that closely, staying invested is a consistently winning formula. So I'm giving you kind of two different tales, two different twists. Buffett is pretty much a buy and hold with very, very rare exceptions. We've talked about how he's raised a lot of cash over the past 8 months, sold out his Bank of America position, sold his Apple position. Druckenmiller sold his Nvidia position, several of them. But if you have knowledge, utilize it. If you don't, you're better off buying and holding. Now, one thing that you can kind of do is take advantage of opportunity. When everybody in the market is getting greedy and says, the market can't fall, we're smarter, brighter, we know what we're doing, everything's great. That's probably the time you want to start getting more cautious. Be fearful when others are greedy. Flip side is you want to be greedy when others are fearful. If you haven't watched the 1980s movie Wall Street, starring Michael Douglas, it's a good movie, and he portrays a character in there called Gordon Gekko, who buys companies and then sells them off in pieces because the management wasn't realizing the full value of the firm, and the value of the pieces was greater than the sum of the parts. And he was at a shareholders meeting, and the management was making its case, asking the shareholders not to sell their shares to Gekko because they would ultimately realize the true value. And Gekko got up and made kind of a legendary speech. And he started off saying, greed is good. Greed works. Is he right? Is greed good? Now that's kind of one thing I love, about the English language, is the words oftentimes are very poorly defined. I can sit here and say, I love my house, I love my dog, I love my daughter, I love my wife, for a while anyway. I loved my parents. But each one of it's the same word, but each one of those has a different meaning. Greed is the same thing. There is a greed that is commended, and there's a greed that's condemned. The greed that is good, everybody cares about the value of their labor. They care about their resources, their assets. They care on what they spend their money on. They want value. They want value for their money. And it's this knowledge that consumers are trying to find the best value that motivates companies to improve their product, to try to offer better value to the consumer so the consumer buys their product, whether it's, additional features, more variety, or just a lower price, whatever they need to do to try to find a way to offer the customers more value. That's what forces innovation. That's what leads to higher living standards and productivity, having better products, more choices. Well, the other side of greed is the obsessive type, where material things become more important than people and other things. That ultimately leads to destruction. I've seen a lot of companies get so obsessed with their bottom line, they forget about their products. The bureaucracy grows so much, they can't make decisions, they can't respond to market changes. Bankruptcy, like GM. In the 60s, everybody was scared GM was going to rule the world because it was so big, so powerful, so rich. Well, by the 80s, they were strapped for cash. They were bleeding cash out the wazoo. Japanese and German products were stealing all their business, were taking all their business. Shouldn't say stealing. They had horrible management. They had huge unfunded liabilities. Eventually, they struggled along for a decade or two, and then eventually went bankrupt. Wasn't an immediate effect, but ultimately it happened. Their own ineptitude, their own bureaucracy did them in. Now, this chart that you see shows the S&P 500 from, 2004 up to, this week. And this little red arrow, this period before it, this is the subprime crisis. And if you look at that, you think, oh, that doesn't look bad, particularly compared to some of these drops, in 2020 and 2022. But the perspective is misleading. Here, the market was up to about 1,500, 1,600, and it dropped to about 820, 830. That's over a 50% drop. That's pretty severe. So you can't really sense that percentage-wise size of a drop compared to some of these others. But a severe drop. It was a horrible market, if you remember. Well, the red arrow shows the point in time when Buffett started buying. He didn't get excited. He didn't get emotional. He kept waiting. And when he started sensing, after Lehman collapsed, the market just tanked. And he thought, and then the Fed started stepping in, the Treasury started stepping in, guaranteeing stuff. And that's when Buffett thought, this is probably near the bottom. Things just can't get much worse. That's when he started buying. And if you look at the results over time, almost perfect timing. You will never sell at the absolute top. You'll never buy at the absolute bottom. If you do, it's luck. But you can greatly influence your returns by using information to make better decisions. Druckenmiller is a strong contrarian, but he also emphasizes quick pivots. We talked about how in 1999, one of his self-admitted big mistakes was dabbling in the tech stocks. Well, he, kind of became afraid of missing out. He regretted it. He regretted the decision quickly and exited. He's been quoted as saying, when I bought $6 billion worth of tech stocks, I knew I was wrong within days. He learned that peer pressure is no substitute for sound investing principles. He's also stated he literally bought the stocks about 1 hour before they topped. So knowing that, how do you know Druckenmiller was a genius and not emotional? Well, he exited even faster than he entered. He bought the stocks over several months and he dumped them in a few days in March. He bought in December, January, he dumped them all in March. Contrarian investing, going against the grain, is powerful. It's difficult, but it requires patience and mostly confidence. But it is almost undeniably the best investment technique consistently. Now we talked about Druck and peer pressure. I thought I would just go ahead and show this. This is the Nasdaq Composite, which was most affected by the dot-com bubble, and you can see it here peaking in late 2000, early 2001. That's that's about where Druckenmiller bought it, and then sold it a month later. Now Druckenmiller will freely say that ego is the enemy investing. He did not stubbornly hold on as his position started dropping. He shifted when he saw he was wrong, wasn't emotional about it, and he preserved his capital by staying agile. He ended up losing about 3 billion, but if he'd have held on, he would have lost a whole lot more. So investing, clinging to your original opinion is like clinging to a bad haircut. You're the only one that thinks it's working. You have got to amend your opinion and your position as you have new information, as the information changes. Now, Buffett doesn't do quick pivots, but he also readily admits his mistakes. Selling companies he misjudges. One of the biggest trades he's made that he's regretted has been buying IBM. He started buying IBM in 2011. Once the economy got out of the subprime area, he invested somewhere around $10 billion, which is a pretty good chunk. It was uncharacteristic for him because Buffett has never been big on tech companies. He just freely admits he doesn't understand the business, doesn't understand the industry, and has kind of shied away from it. But he bought IBM due to what he perceived as their rapid evolution, their advantage in competitive pressures. IBM was stable, thought it could generate steady cash flows. That's really what he looks for, and had a large customer base with what you would call high switching costs. If they have IBM computers and programs, it's expensive for them to throw that out and implement somebody else's software, buy somebody else's computers. High switching costs. So he thought IBM was a relatively stable and had good growth prospects. He thought they were dominant in IT. So he believed that, as the shift to cloud-based services grew, that IBM was well positioned to take advantage of that. He was wrong. IBM's business fundamentals, began to deteriorate really shortly after Buffett purchased it. IBM was just never really able to adopt to the cloud strategy, to the cloud computing revolution. And cloud computing is that instead of running software on your computer, you run it off the internet via the cloud, as it's referred to. Well, IBM was never able to successfully navigate that and take advantage of it. They lost ground consistently to Amazon and Microsoft, other companies. So as their earnings and growth stagnated, it just kept getting worse. So by 2017, it was 5-6 years later, Buffett admitted that IBM had not performed as well as he expected, and he sold the shares. Buffett admits he made a mistake. He misjudged the company's competitive position. He admitted his estimation of IBM's future was too optimistic. He changed course once he understood that his projected reality wasn't happening. So
Or
don't
that
get
I or that IBM could not adapt.
Yeah. IBM just was IBM still should be a computing giant, but nobody mentions them now. Nobody thinks about them. They have fallen so far behind, they're not even, in the conversation anymore as far as the computing future, AI, all of that. They may sneak up and, come out of nowhere, but nobody's expecting it that I've seen or heard. Just really haven't heard any
Yeah.
mention of IBM in years.
No, the ThinkPad was like their big thing.
And that was their last big thing, and that was
Mhm.
a decade ago.
Uh, More than a decade.
Yeah. So the bottom line, don't get attached to an investment. Learning to say I was wrong can save you from bigger losses. Simple recap, don't lose money. Rule number 1. Rule number 2, always remember rule number 1. Number 2, control your risk. And controlling risk means you may diversify or sometimes you may not. There may be time, if I'm buying a house in 6 months and I've got $20,000 saved up, I probably don't want to take big risk with that money because if something happens, I can't buy the house. So I'm pretty conservative. But if I'm a young person and I don't need to touch the money for 10 years, 20 years, I'm thinking that I don't mind some volatility. I'm going to put that money in an industry or sector like tech, maybe crypto, whatever, that I think has a tremendous future over the next 5 or 10 years. Crypto, I personally think, some like Bitcoin and Ethereum have a very bright future. But you could buy Bitcoin today at 66 and in 3 months it's at 55. What do? You just smile and hold on and say, that's just the nature of the beast. It'll be up to 75 or 100 by, I don't know, the end of the year. Who knows? So control risk, your understanding of risk. If you don't understand, that's one position you should take. If you do understand and have, good information, there's another position you should take. Number 3, invest in the good times. Invest even more in the bad times.
Clay, would you
Yes,
invest in McDonald's right now?
ma'am. Actually, I will. It depends on how young or whatever I am. Right now, I would not,
I know you
because
won't. Yeah.
I'm concerned about the market as a whole. And also, McDonald's normally in a recession does well. Historically, McDonald's, Walmart, trailer homes do well, but their prices have gone up so much, people aren't buying stuff there as much anymore.
We know
It
about
used to get,
the onion thing.
yeah, and the
Okay.
what you call it?
E. coli
What's the
or Ebola, one of the
yeah,
two.
E. coli. The thing is, an E. coli incident happens in every state at some restaurant every month. Practical reality. People may not wash their hands good, or you're eating, you didn't wash your hands good. You grabbed a doorknob, you whatever. Don't know where it comes from. But one person getting, a few people getting E. coli is not an unheard of phenomenon. McDonald's is getting hammered over it though.
It was like
Why?
what, seven states, and it was in the onions, is what they're saying.
Yeah. And that's not unheard of. But it is all the
Chipotle,
headlines now.
yeah, Chipotle was had that issue.
Yeah. It's happened previously.
Mhm.
And it hasn't been headlines in the news. McDonald's event is. Why? I can only guess.
Well, because
But
Trump just did the McDonald's thing.
You know, apparently that McDonald's has had to hire security guards because people have threatened the employees.
Of that McDonald's or all?
Yeah, that McDonald's
Hmm.
threatened the store and the employees, which is just insane.
Yeah.
Absolutely insane. So, probably wouldn't buy. But it may end up being normally if you see a stock hammered due to emotion, there's some overselling, there's some fear, whatever. It's not just the bad news. Oftentimes they will be oversold. If you buy that, a lot of times you can outperform, you can do well. But with my concern about the market as a whole, I'm on the sideline. Freely admit it. Fourth rule, stay in your lane. Use what you know. What do you know? Put it to advantage. Everybody knows something. Everybody has some familiarity with something. Use it to advantage if you can. If you don't know, but just keep investing. 25, 50, $100, whatever you can do. If you can do more, obviously, the more the better. But if you don't have particular knowledge, you can still take advantage of time. Put it to use. Number 5, don't get emotionally attached to your money. No emotions. It's business. Treat it as such. You'll make mistakes. You'll have bad days. Treat it as such. Number 6, time in the market versus market timing. We talked about, Buffett's philosophy is kind of buy and hold. Druckenmiller will oftentimes try to seize more advantage. Either way, if you see advantage, you confident in it, seize it. Otherwise, buy and hold. Now, let me ask, been talking here for a while. Do we have any questions? No questions? Okay.
Nothing.
If y'all have something, let me know. Finally, majority is usually wrong. If you're trying to follow peer pressure, you see everybody investing in something, there's a really, really good chance you're going to be, the last person on the bus, and that will not work out for you. Momentum is big. It gets a lot of publicity like it did in AMC and GameStop. But those people who see the stock jumping and think, I need to get on this, are the ones who have the biggest losses when
And
reality sets in.
and you should think about if there is some sort of event that affects the stock market, you should think about primary, secondary, and tertiary
Effects.
events. Yeah. Do you want to explain that a little bit?
Yeah. Primary, secondary, tertiary effects. The best way I can explain it is to probably give you an example. When I was trading and the news came across our tickers and screens and everything that Chernobyl was on fire. And so, we turned on the TVs and we're watching and looking, and we saw and heard described this huge radioactive cloud blowing to the west. And obviously, it was a nuclear plant. What would be the primary response you would have to seeing a nuclear plant melt down? As far as investing, you probably would think, and you got to realize every major event is an investment opportunity. So while you may feel sorrow for the event or sad for the people who are suffering from it, flip side is you can still benefit yourself, your family, whatever. So I'm sitting there looking, thinking, okay, nuclear stocks are going to crash. That's the primary effect of seeing a nuclear plant melt down. Flip side is the market had already reacted. all nuke stocks were way down. So by the time I see the news, it's probably highly probably it's too late for me to take care of primary effects.
Mhm.
But usually there's opportunity in the secondary and tertiary effects. So I'm like, Chernobyl. Where the hell is Chernobyl? We didn't have the internet back then. So I'm grabbing an atlas and looking. It's been described as in the western part of the Soviet Union. So I'm going through the maps, looking all over. Finally find it. There's Chernobyl in the town of, I believe it's called Pripyat, which is now in the Ukraine. And I'm looking, thinking, this radioactive smoke and steam is blowing to the west. Well, I was hoping to see like an industrial valley like the Ruhr or some big city or some big industry, but there was nothing for 500 or 1,000 miles. Just land. No real major cities. And I'm like, all of a sudden it hit me. This area is rather rich or good agricultural land. And so I started, pulled out an encyclopedia, was looking at doing a little research, whatever I could. And the biggest crop grown in the area were two crops, wheat and potatoes. Well, I may not be all that smart, but I kind of realized that the market for potatoes that glow in the dark is really, really limited.
Really?
Not a big demand. And so, that chunk of potatoes, that chunk of wheat was trash. The supply of those two staples was going to drop significantly. Supply and demand is still a law. If the supply drops, demand remains constant, the price is going up. So, secondary effect, potatoes and wheat prices jump higher. So I buy some futures contracts on potato prices and wheat contracts. There are futures contracts out on both. Ends up making some decent money. Tertiary effects. That was the secondary. Tertiary effects. What do they do with the potatoes in Russia?
Vodka.
Make vodka. So what's going to happen to the price of vodka when they can't get enough potatoes? It's going up. So I started looking up some vodka producers, big vodka producers. Stocks went up over time. So primary was the direct impact. Secondary is looking for down the road impacts. Tertiary is looking for the down the road impacts of the down the road impacts. So you had nuke plants, potatoes, vodka. Nuke plant was the main thing, nuke stocks. Well, what was that harming? Potatoes. Well, what are potatoes used for? Vodka. Primary, secondary, tertiary effects.
So if you had seen, okay, there's a nuclear plant and it's in Russia and it's going to affect potatoes because the first people to come in and try to do the, immediate nuclear effects, you've lost that already. You're not going to
Yes,
be able to
it's too
do
late.
that. Yeah. So think about tertiary, which is, okay, vodka. And then you would have done very well in that market.
There's almost always opportunity. You have to think about it a little bit. You may have to do a little bit of research, but the main thing is speed. When you see a big event happening, I mean, like 3 Mile Island also had an incident, but nothing radioactive was released. There was no real downstream effects. The only real effect was 3 Mile Island. You could probably figure it was going to be shut down. And so electricity prices might go up in New York. Whoever, I forget who the energy company is, that energy company will charge higher prices, might get, a little bump in profits. Their stock might go up a little bit. But really, it got a lot of news, but the impacts of that were not severe. They were really relatively modest. 9/11. First plane, I hear the first plane goes in and I'm thinking it's a Cessna. Some pilot got drunk, lost, passed out, had his plane on autopilot. I didn't know. Didn't really think anything about it. And then a second plane hit. And that's when I started watching the news. I knew then it was intentional, that we were under attack. You knew then that we were going to war somewhere. You knew then that defense stocks were gold. The rest of the market, maybe not so much. But most every major event has attendant reaction in the market. And then the final rule is majority is usually wrong. And keep humble. You can make mistakes. You will make mistakes. You will have bad investments. Welcome to the human race. It happens. You cut your losses like Druckenmiller did and move on. That's the way that you be successful. These rules, these 8 rules, are what separates disciplined investors from gamblers. The aim in investing is not to be able to predict every little dip or tremble or fluctuation, not every rise, but to position yourself in a way that won't ultimately have you questioning every decision. You make informed decisions. You make the best ones you know. You can. And you're confident in that. You're content in that. New information comes along, you adapt, improvise, overcome. That's how you invest. That's the basic rules to investing. Now, let me ask you, do y'all have any rules that you've used to invest by? Or, what are some of your biggest mistakes? What lessons have you learned?
Nobody wants to admit that.
It's a good opportunity. The therapist, put my little therapist shingle up, the
Mhm.
counselor is in. What sectors do you think you have the most or sufficient knowledge in? I've made a number of mistakes investing, and I've talked about them before. Shorting GM, which actually was the right decision, but the market was stupid, and I had too much ego involved. Ended up costing me a fair penny for that kind of tuition. And these principles are really timeless. You can apply them to the market in most any era, any period. They just don't change. People forget them. People ignore them. People aren't aware of them. But they still are rules. They still are the key to successful investing. A few other things. This, just I kind of call this adiaphora, things indifferent. Um, and this is where I've just seen some interesting data or stuff during the week, and I just kind of am passing it along. We talk about housing a lot on this show.
Jane.
If you don't have time to learn and watch the market, hire a professional to do it for you. Like a mutual fund. You don't have to have a specific financial advisor. A lot of financial advisors are insurance agents. who really may not be the best one to handle your investments. Some of them may be stockbrokers that get paid commissions. Now, I'm not saying that anything's wrong with either one of these. Inherently, there's not. But the reality is that those industries over time have had a fair number of their employees who don't necessarily look after the best interest of the client. So you have to be very careful. But there are investments like mutual funds, you don't need somebody else to make the investment. You can make it directly yourself. And it's really quite simple. We've talked about it some on beginning investing and some other videos that we've had before. If you have some questions on how to do that, email me, moffitonmoney.com, or DM me on Twitter. If I
Yep.
get enough
Moffat,
questions or comments, I'll do another video.
moffitonmoney@gmail.com.
Yeah, sorry.
Or
moffitonmoney@gmail.com. What'd I say?
okay, moffitonmoney.com.
Oh, yeah, sorry.
There you go.
Yeah, feel free to contact me if you have some questions. But I saw this courtesy of Venture Consulting. And the orange line is the average mortgage rate. And you can tell that it's spiked since 22, gone from, they have 2.7 as the low. I actually got mine at 2.5%. So I still use 2.5% as the low. But from 2.7 on up to 7.6. Late in 22, early in 24. And since then, it's fluctuated a little bit. It went down to 6.2. The Federal Reserve cut rates. The market since then, the mortgage market, the average mortgage rate has gone up. Right now, this graph shows it at 6.5. Right now, it's right under 7, 6.8, 6.9. Federal Reserve cuts rates. Mortgage rates have gone up. I showed you, last Tuesday how the whole treasury curve 1 year and out, the rates have increased.
But rent
Well,
has too.
Yep. And this is the underlying problem, is that there is a point to this. You see that blue line, that turquoise line. Well, that's the return that investors get on rental property or on commercial property. And you can tell that, since 2013, that return has dropped from 5.7 on average down to about 4.5, 4.8. The problem is they're making 4.8% on the investment, but they're having to pay 7% for the money.
Mm-hmm.
This will greatly reduce the incentive to buy or build property and use it for rent. So, you can tell here that the cap rate generally is higher than the mortgage rate since, 2010, 2011. Well, that changed a few years ago. And what has happened to rent since then? They've soared.
Skyrocketed.
Yeah.
Yep.
What's happened to housing prices? They've soared.
Soared.
So you don't see people buying houses to convert them to rental property. You don't see private owners trying to rent their houses.
No, I mean, I had a rental. Was it before I moved down here? When I say down here, I was in Wilmington. It was $1,250, 3 bedrooms, 2 bathrooms. Had a big yard, all the things. And as soon as I left, the rent went up to $1,850, and that was in 2018.
Yeah.
So yeah, I mean it's crazy. I mean that's $600 and I was there for 3 years.
Yeah. and it's probably gone another $600, $800, maybe $1,000 looking at, common rental rates in the city.
So it's
It's
not even worth it to rent anywhere. It's like it's so expensive, but then you can't buy because it's so expensive.
it
Unless
is.
you're an immigrant, then you can do whatever you want to.
And there's some other data out there which really doesn't look all that terribly good. Houses for sale right now are at a 5-year high. So that kind of makes me wonder, or think in the back of my mind, are institutions starting to sell? Are these Airbnb owners starting to sell? You've got a lot of rental property in Florida and Texas that people are going to start dumping on the market. There's some interesting things going on in the housing market. If we look at housing prices specifically, I mean, this corner of the graph tells you everything you need to know. You can see housing prices, um, in terms of their median sales price, was modestly stable, consistent, slow growth from, the 1970s through basically 2019, 2020. And then boom. Now you can tell that, the past few months they've dropped a little bit. This past month they actually ticked up a little bit, but I don't really trust that number because the previous 3 months were revised down. So when you have numbers revised down and you get a little bump up, if the numbers had been where they were previously, it would have been down 4 months in a row.
Yep.
So, kind of hard to tell. Oh, I wanted to say this also. We've talked about energy a little earlier, and we've talked about the need for cheap, stable energy, abundant energy. So that's really driving the need for nukes, increasing the demand and the growing, what do you call it? I want to say demand. I already used that word, but the growing demand for more nuclear power to restart up some nukes, like 3 Mile Island is being restarted. Meta has signed a contract and will pay for 3 Mile Island to start back up so that it can supply power to its data center. Well, there's a new ETF. For those of you that think nuclear has a future and you don't know which companies to buy, here's one of the options for you. You can buy an ETF. It's an electronically traded fund. And this ETF picks out the company. So it's got, a professional manager picking out the company. It's just kind of a good way to gain exposure to this field if you don't have specific knowledge or information, but you think it has a good future. Nukes. Cute little name. Looking back to housing and rental, sales of houses are falling. Interest rates are rising. The number of houses pending sale is dropping. And look at it long term. Boomers. Boomers. I'm a boomer.
Yep.
Being a boomer. The
Yep.
reality is every day more and more boomers die. I have over the past year lost, I don't know, a dozen friends I went to high school with. Not trying to be morbid, but simple reality is boomers are dying off. And as more and more of them die, their homes are going up for sale. Supply will therefore increase over the next few years. What about demand? I don't know. You think as supply decreases, there demand would, more people would demand it, and they may temporarily. But you look at the demographics, and this is a consequence I've been warning about for, years and talked about on the show repeatedly. The demographics of the country. Birth rates have gotten so low that you kind of have to wonder, is there going to be anyone to buy the house years from now when you want to sell it? People say owning a home has been the most significant contributor to personal wealth over the past 75 or 100 years. Is it reasonable to believe that will continue when you've got increasing supply and quite possibly decreasing demand? I don't exactly know. I can't prophesy, and I try never to prophesy how that will exactly turn out, but I'm not optimistic. Rates aren't going to drop anytime soon, not greatly. We are going to have higher for longer.
Mhm.
Inventory is still dropping. That'll change shortly. Pending home sales right now are down near 10 or 15-year lows. So I don't expect a rapid drop in median price anytime soon, but over the next few years, as this supply steadily increases, as more and more boomers die, I just wonder if owning a home has the same promise that it has had for the past 75 or 100 years. We need some major changes in supply and demand to bring that about. It's not just one-sided. So, is it reasonable to believe that that will continue? Anybody have any questions?
I don't think so.
That is, all I had for tonight. Would like to ask you, if you will, hit the like and subscribe button. Hope there were some things, covered that you thought were of interest or value. If you will, share with your friends, family, kinfolk.
Tuesday or maybe Saturday, I have seen some people saying that the millennials are the wealthiest generation at this point. So I'd like to hear your thoughts on that. Tuesday or Saturday, just
Okay.
something to think about.
Can do that.
Sweet.
And what was the exact comment? The millennials are the wealthiest generation or will be?
Are.
Interesting.
So
Did they
I'll
give a
have to.
source or site for that?
I can't remember. To be honest, it was like several days ago. I'll have to look it up again.
Okay. But yeah, we'll talk about that a little bit.
Okay.
And if you're watching and you have some other questions or comments or something hits you after the show's over, then again, email me or DM me on Twitter. If you haven't followed on Twitter, please do.
Or send me a message if some of you feel more comfortable. I think sending me messages sometimes. It seems to be a thing. So I'm Ellen Lee 5 on X.
Yeah, I keep calling it Twitter, but
And it's
X.
LEA, ELLEN, LEA 5. The number 5.
So we hope to hear from you.
Please.
We've really had some good engagements with some members of the family, and we enjoy it. We've got developed some really good friendships off this show, and we appreciate that greatly. Really do.
Absolutely.
So
Well,
if there are no other,
y'all have a lovely evening.
Yeah, if there are no other questions or comments, we'll go ahead and break here. We hope y'all have a great rest of the weekend.
Mm-hmm.
We thank you for joining us, and for those on the replay crew, we love you guys too. Y'all have a great week. We'll talk to you soon. Talk to you Tuesday. Hope to see you Tuesday night.
Thank you.
Our time is up. We thank you for yours.